During the last 2 years, Egyptian tech startups attracted over $1 billion of investments. This is more than 3 times the number of the previous 2 years. Do you know what fueled this huge growth? Or what are the challenges that we're facing startups this year? Over the past 2 months, I've been researching in more than 400 resources about the state of VC funding to Egyptian startups, trying to answer these questions. In this video, I'll share with you my key findings, and I present you main strategies every entrepreneur should embrace to survive beyond 2023. So let's get started.
Investors pumped a record $93 billion in investments into early stage startups last year.
These supply chain tech startups are now being chased by venture capital money.
The venture capital industry had a record-setting 2021 by any metric.
The global venture capital funding broke all records in 21, hitting around $643 billion, up 92% from $335 billion in 2020. Venture capital firms were flooding into tech companies at record levels in the post-pandemic economy booming period, driven mainly by fear of missing out. According to the Global Private Equity Report in 22, the amount of excess liquidity, or the dry powder as it's called, was around $3.4 trillion in 21. The booming startup market prompted an investment rush by investors that was characterized by bigger checks, fewer days for deals closure, faster cycle rounds, loosened due diligence measures, and much higher valuations, all in hope of catching opportunities that were actually accelerated by the pandemic lockdown conditions. So how was the startup ecosystem in Egypt prepared for this global boom in funding?
The ecosystem in Egypt is developing quite well.
The market has moved a lot in the past decade, a lot.
Since we first invested in Egypt, the ecosystem has grown tremendously.
In our first cohort, October 2011, we struggled to find 5 to 6 good companies that I'd be willing to put $10,000 to $15,000 in. Now, I struggle to limit my cohort to 10 companies that I'm putting $100,000 to $150,000 in.
We manage nearly $3 billion in assets for the Africa region, of which about $500 million is invested here in Egypt.
Egypt is a market we all know well. We've been investing in Egyptian seed stage startups for over a decade, and today have more than 80 Egyptian companies in our portfolio. We have found exceptional founders in Egypt who are ready to serve the largest market in the Arab world and beyond, such as social commerce platform Breemord, online home furniture startup HomeSmart, an online grocery delivery service Breadfast, and many more.
I'm very bullish on the future of VC in the region and in Egypt in particular.
We are tremendously bullish about the Egyptian market, and for us, this is one of the most compelling geographies globally with a tremendous entrepreneurial group.
With this evolution of the ecosystem in Egypt, this global booming trend in VC funding was the main fuel for the rise of VC investments in Egypt by more than 200% in 21 from 2020. But this was not only specific to Egypt. Actually, both the regional and African growth percentages of investment data were also high. However, what was specifically notable was the rise of fintech startups in Egypt and their continued growth in numbers. So let's see how fintech startups were actually performing globally in 2021.
In 2021, as the pandemic continued to push buying and banking online and the price of both Bitcoin and tech stocks climbed, venture capitalists poured money into fintech, a total of $133 billion globally, almost 3 times the $49 billion they invested the year before. That flood of capital supercharged a new wave of fintech startups, so many that half of this year's Forbes Fintech 50 list are newcomers.
Turning now to Stripe, it's fast becoming one of America's most important e-commerce players, and investors are paying up for access as it gradually prepares for an IPO. It's now valued at $95 billion. That makes it also America's most valuable private tech startup.
The buy now, pay later shopping app Klarna has just completed a fresh funding round, which tripled its valuation to an estimated $31 billion. That makes it more valuable than Germany's biggest lender, Deutsche Bank.
Sebastian, I don't know if we can call you a startup anymore at $45 billion, but wow. I mean, last time you joined us, you said that you want to disrupt the financial services industry just like Tesla has disrupted the car market.
To understand how 2021 was an exceptional booming year for fintech startups, currently there are about 433 fintech unicorns globally. 40% of them were actually created only in 2021. And this attention to fintech startups was for the very good reasons.
So what caused fintech to get so much attention and excitement initially is there's a lot of potential. You know, when you think about meeting customers where they are, delivering banking services more cheaply and efficiently, there's really a lot of opportunities to give better services to people and for much cheaper. And so that combined with COVID, a surge in online transactions, people not wanting to go to a bank in person, really created a lot of tailwind behind fintech and a ton of interest in investing.
So Egypt, with its big market and high internet connectivity and mobile penetration, received this investment attention as well, which really explains how Egypt saw its first mega deal of $120 million in 21 for a fintech as well as a transport and logistics startup called Halan, the same startup that received another total investment of $400 million in 23, becoming the second fintech unicorn in Egypt after Fawry.
Having achieved the status is very rewarding. The team feels very, very proud. For the ecosystem, it's nice if you're an Egyptian company, another Egyptian company, or Arab, or Middle Eastern, or African, and you see that a company has been able to achieve a unicorn status, then it's an inspiration, I'm sure, for a lot of up-and-coming startups.
And the inspiration did take place. Egypt had many fintech startups in recent years achieving very decent investment rounds relative to other sectors. Actually, fintech was the top sector in terms of number of deals in 21 and the top sector in terms of funding amount in 22. And if you consider Halan as both a fintech and a logistics startup, fintech sector was actually number one in funding amount in both years.
Actually, it's been great, especially for the fintech world in the past 4 to 5 years. Egypt has been really focusing on closing the gap for like financial inclusion as well as digital acceptance. So what happened actually, the central bank has pushed so many new policies as well as like new initiatives to subsidize a lot of like the money and the work needs to be done to close this gap, and actually helped a lot of the fintechs, which we were one of them, and we've participated along with all of the initiatives.
The global surge of fintech investments were coupled by the Egyptian government passing a law that allows the Central Bank of Egypt to give out banking licenses to fintech firms. This, along with the launch of the Fintech Initiative and more funds flowing into investments, led to an explosion of the fintech ecosystem in Egypt. However, all these factors were not the only ones contributing to the rise of fintech startups in Egypt. One other important factor was actually taking ecosystems by a storm, which was the BNPL lending model. Buy now, pay later.
Buy now, pay later.
Buy now, pay later firms have boomed over the last 3 years. And companies like PayPal, Apple, and credit cards themselves are joining in on the hype.
Buy now, pay later services. You've probably seen them when you shop online, encouraging you to pay for products in installments rather than all at once.
Buy now, pay later services accounted for $97 billion in e-commerce payments in 2020, and more merchants are hopping on board. A firm reported 102,000 participating merchants thanks to e-commerce company Shopify adding support for the brand.
The buy now, pay later model took ecosystems by a storm, especially after the pandemic. It came as a perfect solution to the rising prices everywhere, making itself a form of debt that's not yet regulated. And this global trend found a great adoption in Egypt. Big time. The gross merchandise value is forecasted to exceed $6 billion in 2028 from only $1.7 billion in 2023 in Egypt. However, there are real concerns about BNPL everywhere, as it encourages unsustainable spending and can put the consumers at the risk of debt.
Buy now, pay later services, or BNPL for short, have exploded in popularity over the last few years, especially among millennial and Gen Z consumers. And that has some analysts concerned.
It looks pretty innocuous, on the surface, like, what harm could this really do? But using it repetitively and in close proximity could really create a downward spiral for debt.
The Consumer Financial Protection Bureau has requested information from some of the largest BNPL providers in the U.S. as part of an inquiry it opened into the industry in December of 2021.
A third of BNPL users reported falling behind on at least one payment. BNPL can also make it easier to buy things you can't necessarily afford. 57% of users said they regretted their purchase because the item was too expensive. At the end of the day, a BNPL purchase is still debt.
And these concerns were also voiced in Egypt, as the rising costs have been a boom for BNPL. The recent state regulations and economic reforms have boosted a fast growth of the sector since the second quarter of 2020, which created many adoption practices of BNPL, like Amazon Egypt announcing that it will begin offering BNPL services to approved buyers through the Fintech startup Value. Then, the inflation and more rise in prices have prompted more growth in consumer finance and other non-banking financial services like BNPL, as stated by the CEO of BTech. However, Professor Mahmoud Saeed, Dean of the Faculty of Economics and Political Science at Cairo University, points out that, despite their benefits, these companies may lead consumers to spend more than they can afford to repay, which could in turn lead to default in the future, an increase in the number of people in debt beyond the ability of the society. These conditions can be seen as mirroring a perfect consumer economy cycle, in which the fintech startups offering BNPL lending services are basically allowing citizens to have access to more than what they can currently afford. And with the increased purchasing power, consumers buy more and e-commerce platforms' revenues grow. And of course, the more goods are sold online, the more delivery services are required. And this whole cycle is boosted by the financial inclusion policies and the increased internet connectivity. And you can call these dynamics consumerism on steroids. So it really comes at no surprise that the most funded startups during the past 2 years were actually in these three sectors: fintech, e-commerce, and transport and logistics, as they actually boost each other in any consumer society. However, the signs of downturn coming in quickly in 22 were showing a reverse in direction, as startups globally were being urged to cut spending.
Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down.
With inflation hovering around its highest rate in 40 years, the Federal Reserve is expected to raise interest rates several times in 2022. You can see on this chart that the rate was lowered to nearly 0% in 2020 to boost the economy at the beginning of the pandemic.
We've raised the federal funds rate by 500 basis points since a little more than a year ago. We also think that there's more tightening power coming through.
The speed of this hiking cycle is distorting Wall Street and reshaping personal finance in America.
We are in a different environment than what we've experienced over the past 15 years.
In August 22, the Financial Times have predicted a silent crash in VC funding and alarmed that the party is over. Those who witnessed the historic boom in funding in 21 have walked into a new reality where the world has changed drastically, and the uncertainty about when capital will be freely available again has fostered an inevitable caution.
We are currently experiencing a central banker's vibe of higher for longer. You're to some extent limiting non-productive investments that would not necessarily generate revenue in this high interest rate environment. It's very different in a low interest rate environment where money is free, and essentially any type of investment is really worth it because the cost of capital is close to zero.
The economy grew steadily through the 2010s as more cash went into risky investments. Startups disrupted the transportation, housing, and tech industries, but some companies can't handle today's higher interest rates. In the first half of 2023, there have been 41 corporate defaults in the US, the most of any region globally.
And those were the ones who couldn't survive. However, others immediately adapted by laying off thousands of employees.
The tech sector shed more than 386,000 jobs in 2022 and the first half of 2023, and that number is climbing.
Google today joined a growing list of tech giants scaling back, adding to the tens of thousands of workers in the industry who find themselves unemployed.
They grew too quickly during the pandemic
there was this glut of spending on tech products when the pandemic first hit and people were stuck at home and businesses had to find ways to help their employees work from home. So that means buying a lot of computers, buying a lot of IT services, Zoom subscriptions, you name it. That all caused a lot of money to be injected into the tech industry. And some people in the tech industry, some executives, got a little overconfident thinking this growth is going to be sustained forever. Let's hire now and get ready for that growth. But they over projected it. And now we're seeing an economic slowdown and everything's coming home to roost.
Nothing can describe these new harsh conditions better than the loss of 85% of Klarna's valuation, the once second most valuable fintech startup in the world offering BNPL service. It was just because investors are suddenly voting in the opposite manner to the way they voted for in the past few years.
Companies like Affirm and Klarna got a ton of attention, really high valuations. During COVID especially, there was a view that this was going to change banking completely, but the valuations that they were getting end up not being justifiable when you look at the revenue they're bringing in.
The darn thing has lost 85% of its value. And Klarna is just the latest disappointment of many in the buy now, pay later universe, as well as the broader lending technology space. These stocks were red hot a year ago, yet now they're one of the weakest areas of the market.
And in this new high interest rate environment, the global VC funding was primed for a reset in 23, dropping by nearly 50% in the first half of the year in the once booming fintech sector, the darling sector to VCs. And it was about the same ratio for all funding.
Venture funding felt the pain in the first quarter, according to new data from Crunchbase. And despite a couple of massive deals, global VC funding fell 53% as investors continue to hold on to their dry powder. Allie, what are the details on this funding drought?
Yeah, the headline looks bad, Jared. It does. And that's because it is bad. And if you dive deeper into the data also looks roughly as bad.
Well, the data for Egypt was also bad, as funding for startups was drying up. The published news from Magnet on their X account was signaling an average of 45% drop in funding for MENA region, especially in fintech, comparing Q3 of 23 to Q3 of 22. However, if we look deeply in Egypt, the funding reported by Magnet till Q3 was only $335 million, which means that excluding the $260 million VC funding of Haaland this year, the whole ecosystem of startups had a drop of 80% in funding as compared to Q3 in 22, sharing only $75 million. And that's how the bad news was for Egypt. With all these challenging conditions globally and in Egypt, no one was prepared for another shockwave of an extinction level event like the coming one.
The collapse of Silicon Valley Bank is causing shockwaves across the entire business world.
It's the second biggest bank collapse in U.S. history.
It is the epicenter of tech startups, venture capital.
4 decades after its creation, Silicon Valley Bank was the 16th largest bank in the U.S. It took just a day and a half for it to fall apart.
Silicon Valley Bank was the home of tech startups and held around $200 billion in assets. It collapsed on March 10th. The biggest lender to do so since the global financial crisis.
Now, what can we attribute this to, right? Of course, there's the macroeconomic environment of 2022, whether it's high interest rates, the war in Ukraine, supply chain problems. And we may not be at the bottom of this cycle, we don't know. But what we do know is actually the collapse of SVB it was a shock to an already difficult environment for a lot of these startups.
The SVB collapse left a big hole in the startup world. Startups began to run out of time and money, and unicorns began transforming into zombie firms that are just staying afloat by taking more debt, and their number is on the rise. Over 3,200 venture-backed startups in the US only have failed this year. Their number was in rise since Q2 in 22. These failing startups have raised already a total funding of more than $27 billion, which is now up in smoke, as per data compiled by PitchBook for the New York Times. Experts say that the real number is actually higher than that. Note that the top reason why startups fail is simply running out of cash or failing to raise new funding rounds, which has been a very hard job this year.
By the way, speaking of IPOs, Morning Brew posted a shocking note. This really blew my mind. 3,200 private VC-backed startups have gone out of business this year. Golly, that's hard to imagine, right? They call it a mass extinction event.
In the United States, at least 10% of publicly listed companies are taking on debts that they probably can't repay. Economists call these unviable companies zombie firms.
They crowd out capital that would otherwise be available to healthy firms.
Zombie firms are a growing problem around the world.
The share of zombie firms has been increasing over time. This has detrimental effects to the healthy firms that compete in the same sector.
If a company has to die because the world has changed permanently, let it die.
The Fed's swift interest rate hikes are making long-suspected zombie firms go bankrupt.
The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation.
As these rates rise, it's becoming more expensive to do a lot of things, including operating a business.
There are some firms that actually really should no longer exist.
Bankruptcy.
A stunning fall.
Major restructuring. Debt is piling up. Companies are filing for bankruptcy now at the fastest rate since 2020.
In March 2022, 44 founders of unicorns, private companies valued at over $1 billion, were worth a total of $190 billion, according to Forbes estimates. A year later, Forbes has revalued the world's billionaire-backed unicorns. The results are stark. Half of the wealth of the billionaires behind unicorns has been wiped out.
The tech industry has its own pressures, mainly because most startups are unprofitable and depend on cheap financing.
The appetite for risk has declined a bit. There's less capital available to companies, particularly those that are growing.
Higher rates make these new tech companies less attractive because investors want to see proof of profits immediately. Big companies respond by cutting jobs to reduce costs. Small companies struggle to raise funding.
Well, I think maybe you should think of it in terms of medicine. Sometimes the medicine that you need to correct a condition really may taste awful and may make you feel ill for a short time before you get better. And this is the way it is with higher interest rates. Certainly we need higher interest rates. You can't maintain forever a period of ultra-low rates, and central banks around the world are addressing that issue. So over the longer term, it's going to correct the problem of too easy access to capital, too much debt, and so on. In the short term, though, higher rates are going to cause a lot of pain, and particularly for the kinds of companies that we've been talking about, these zombie firms whose earnings are not sufficient even to cover their debt service, let alone investment and operating costs. That's why we call them zombies. They're on borrowed time.
Earlier in 22, many prominent accelerators and venture capital firms sent alarming insights to startup founders of the gloomy future ahead, like Y Combinator's letter to founders warning them to plan for the worst, and Sequoia's 52-page deck cautioning founders on a crucible moment and a longer recovery ahead. So in this last section, I'd like to leave you with 4 key points that you need to consider for passing this storm, and I've put them in very simple terms. First, adapt to change. The changes within your startup need to match the level of changes that are taking place around you. And I don't mean simple operational changes, I mean changes in the business model itself that would enable you to have a long runway. Remember that it was developed initially for a different environment. So changes whether in value proposition, customer segments, distribution channels, cost structure, revenue streams, or even partners. And here you can think about merger agreements, which are set to become the norm in African startup ecosystem according to African Business. On December 22nd this year, Maxab, which is an e-commerce B2B startup in Egypt that has received over $100 million funding since 2019, is in merger talks with Wasuku, a Kenyan-based e-commerce startup platform that operates in many African countries. Wasuku recently conducted their largest round of layoffs, and Maxab is actively seeking a survival strategy as its cash reserves are depleting. And What's interesting is that both startups share common investors, so talking to your investors may generate opportunities like this. One of the other major changes is that your headquarters should be in the most optimum location for your business survival. Offshore restructuring is a trend that has been gaining traction recently with the growing tightening conditions influenced by the central bank as a way of hedging against risk, and it does offer its attractive benefits. So if this is a critical problem for your business survival, then you may consider thinking about this tactic. The changes can be in many dimensions. However, founders who face reality adapt fast and have discipline not just survive the storm, but can win over it and thrive. Second point, spend your cash wisely. As capital is now expensive, you need to do the cut exercise of all unnecessary expenses. Your target is to remain lean on your business operations to improve your unit economics so that your business can be seen profitable by investors. So you can think of, instead of hiring new full-time staff, you can start working with freelancers on specific time-limited projects. Instead of having huge marketing budgets, you should really seek new creative ways for marketing that capitalizes on the use of AI technology and big data analytics to optimize your strategy. The use of influencer marketing is very effective. Test new sources of revenue and new markets with small-sized experiments to diversify your sources of revenue. Don't deploy full-force budgets unless the small test experiments proved successful in increasing your margins. Third, use your time efficiently. Time is your greatest asset, so focus on productivity and performance for you and your staff. Control the flow of unnecessary information into your head to keep a clear focus on execution. Don't get distracted thinking you will succeed in closing a new large investment round while investors are not really serious about closing any deals. If you are in a seed or early stage, you would still expect some investment flow. But if you are in later stages, the situation will be more difficult with smaller amounts and lower valuation. Fundraising is a time-consuming and distracting task. If you do not have a strong relation with your investors and seeking to knock the doors of new ones, you may be wasting critical time of focus on your business execution in the most efficient way. Last point, unleash your staff potential. In these times, you need to embrace a real innovation culture within your startup. Be open with your team and acknowledge their fears, as this is a storm that you are all in together. This is a moment when leadership really emerge. So get into collective design thinking exercises with your staff and welcome their inputs on any of the 3 dimensions we talked about, whether in business model changes, wise spending of cash, or efficient use of time. You will be amazed at the creative and innovative proposals coming from your staff once they see a real leader among them steering their ship. I hope you manage to change the lives of those close around you to the best. After all, this is what really defines you as an entrepreneur. And let's remain hopeful and confident. Economic cycles have their ups and downs. The current crisis is likely to stimulate innovation and open up unique opportunities for those who can effectively adapt and pivot, eventually giving a way to a period of growth and prosperity. In conclusion, I tried to summarize the situation that unfolded within these 3 years, highlighting key milestones and their impacts both globally and nationally. And I hope it was informative as well as entertaining. Please leave a comment below with your story, the challenges you are facing, and how you are managing so far. And tell me if you like this type of content so I can keep producing more of it in the future. Thank you and good luck.